Good afternoon, everybody, and welcome to this IMAP webinar, where we have a chance to showcase the winners of the IMAP Managed Account Awards for this year. This week, we're joined by Alex Ventelon and Wayne Chatterjee from Morgan Stanley, the winners of the Licensee Managed Accounts Awards. And next Monday, we'll be joined by Deanne Stewart from Lonsec and Leah Willis from Australian Ethical, the winners of the ESG category. Before I hand over to David McDonald from IMAP, one of the judges, to talk about the judging process, the sorts of things which we look for when we assess the awards each year, I want to say just a little about some of the upcoming events for IMAP. So as I mentioned, next Monday, the ESG best practice webinar. So this is the first year in which we've run an ESG category. And we were very impressed by the quality of the submissions in this category and the depth of thinking embedded in those portfolios. In October in Melbourne, we'll be running the first of our Melbourne Independent Thought Conferences. We ran the first Independent Thought Conference in Sydney this month on the 6th of September, and it was very successful. A chance to showcase the thinking of managers like Alex and Wayne, who are joining us today, Deanne Stewart, who will be joining us next week. The thinking that portfolio managers bring to the construction of portfolios for managed accounts of all sorts. In Melbourne, we'll be focusing on how portfolio managers are approaching key investment issues. And we'll be joined by 15 of Australia's leading portfolio managers in discussing issues such as inflation and interest rates. ESG will be one of the topics for Melbourne, managing risk and volatility in portfolios, dealing with geopolitical factors. In November, Investec, our virtual technology conference, and then in March, a portfolio management conference. So we hope you can join us, take part in those live events, and of course, each fortnight and on a periodic basis, our more virtual events. Of course, if you want to ask a question, it's pretty common knowledge now. So now it's my pleasure to ask David McDonald to kick us off for today by talking about the judging process and the ways in which we assessed the wide range of portfolios submitted by licensees. David, thanks very much, and over to you.
Thank you, Toby. I will just spend a little bit of time going through some of the key things the judges look for in the awards. And then we'll probably talk about some of these a little bit more detail with Wayne and Alex after their little presentation. I mean, as you can see here, one of the most important things we looked at, of course, was the investment philosophy of the award entrants and how that was put into place through an investment process. We didn't look for particular philosophies. I mean, we don't, look to see whether say that value is better than growth managers, that active or passive is better. More to the point, we look at how the entries explain their process, which of those things they might follow, whether it's well thought out and explained properly, and more importantly, perhaps how it's implemented. Do they have a system for putting that process into place into the portfolios that they're running for managed accounts? Morgan Stanley do have a unique process, which we'll hear a little bit more about from the guys soon, and particularly an interesting way of looking at how to combine active and passive in their portfolios, rather than perhaps looking at whether one or the other is better. The judges also look at teams. That's a very important thing in the awards, of course. People like Morgan Stanley, some of the other entrants, of course, have got very large teams and are supported by global organisations with analysts around the world. But not all the finalists had large teams. It's not necessarily the size of the team that matters, but rather the skills there, the qualifications of key personnel in the investment process. Some entrants, for instance, might use external consultants to join their investment committees to boost the resources that they have themselves, and that's also a valid way of doing it. Client communication is another important part of the process and something the judges gave quite a high weighting to in the awards process. We had an IMAP podcast a little while ago that highlighted the importance of clear communication with clients. It's very important in helping clients know what's happening with their investments and make decisions, or perhaps more importantly, sometimes not make decisions when they shouldn't. I mean, we heard about people that see the news and panic about what's happening in the world, put all their money into cash at the worst possible time. Things like that are why it's very important to have a clear process to explain to clients what you're doing with their money and what's happening with the investment processes. Interaction with advisors, obviously a very important part of this particular award, given that it's the licensee managed account award. So we want to know how the investment managers, people like Morgan Stanley in this case, interact with advisors as well as the end clients, what sort of information they provide to the advisors, how often they're communicating with them, and so on. And then lastly, there is definitely a quantitative assessment as part of the process. We look at returns, and particularly risk-adjusted returns, and we also look at fees. It's often been shown that low fees are a very important part of getting good returns from your investments. So a combination of the actual investment returns adjusted for risk and the fees that are being charged by the people running the investments to come into the process when we're judging the awards. So as I said, we will talk about some of these in a little bit more detail with the guys soon and discuss perhaps how they approach some of these things and how it came about to help them win the award. But for the moment, I will hand over to Alex and Wayne from Morgan Stanley to go through their process a little bit more.
Thanks, David. Thanks, Toby, and thanks to all IMAP for having us today. It's always a pleasure to be presenting at these awards. So a great opportunity for us, obviously, to run you through our process and our thinking here at Morgan Stanley. So let's get started on slide number 2. What is our multi-asset portfolio management service here at Morgan Stanley? Well, the key features are really that we are managing multi-asset core portfolios, right? So we try to have a range of multi-asset portfolio that could constitute the core of an investor's portfolio, and that they could take what we call satellite exposure on top of that. But we want to think of ourselves as the steady ones, right? The ones that will set the direction and stick with this direction and try to add outperformance on top of the client's objectives. We have a solid track record. Luckily enough, our predecessors started these model portfolios 10 years ago, actually in April 2012. So we can benefit from this track record, having really been very consistent in terms of our investment strategy and our investment policy, and try to build on the existing rather than reinventing the strategy, so the client know that there's continuity between the various teams that have been the steward of those models. This is really important to us. Another key feature of our models is the fact that we have an active versus a passive selection model that allow us to dynamically choose between active and passive investment. Wayne, who's here with me, we'll talk about it a bit more detail, because he's the one that brought that model to Australia. Of course, one of the key things as well is that and probably that's the most important about those models, is that they are backed by Morgan Stanley Global Research. Our goal here is really to bring in one's portfolio the best of the Morgan Stanley views of the world into a risk managed and fee managed solution. So it's really research backed. And the next added feature following on that, of course, is the fact that we are providing regular communication on our models and our asset allocation views and all the trade ideas. Everything starts with research and then flow onto the implementation of the models. And the last thing, of course, is that we are trying to do that with the most attractive fees so that it doesn't get in the way of the compounding effect for our clients. So in terms of again, presenting the models on the next slide, we've started those models in 2012, and as I mentioned, we are the fourth team, but there's been very high continuity in the way we approach the management of these models with regards to the investment strategy and the investment philosophy. Thanks to this long track record as well, we can show how we've been performing in a very vast variety of market environment and through 2 market cycles now. We are also offering these models as SMAs, some of them on our domestic and global wrap accounts here specifically for Morgan Stanley, but we also offer those models to externals via 3 retail platform, Net Wealth, North, and Premium. In terms of range of models that we are managing on the next slide, this is in further details, what is our right now, what's our offering at Morgan Stanley. One range in particular, as I mentioned, is available on Net Wealth, Premium, and North, which is the one that is orange shaded, which is implemented via domestic securities, i.e. ETFs that are listed here in Australia, or unlisted managed funds with a domicile here in Australia. We are managing another layer of strategies using global securities, so funds that are domiciled overseas, and this is exclusive to Morgan Stanley, as well as our Responsible Investor series, which is a series that is only investing in funds that we do rate with our investing with impact methodology. And then using our global platform, we are also managing another series that is a bit more complex. It uses a lot more alternative investments. So probably not for everyone, but something that's performing very well, especially in times of volatility like that, where we have also 2 subcomponents with either domestic securities or domestic and global securities. Of course, on the next slide, very proud to be the licensee winner this year. It's the 3rd in a row, after having won also the multi-asset next year. And I guess also we take that as a vote of confidence from an external source that we are doing the right thing for our clients in terms of robustness of our offer, risk management, and steady portfolio construction. The one thing that we like to highlight at Morgan Stanley on the next slide is what we call capabilities and global resources, right? Because what matters in the end, we believe to our clients here is that they get the best out of Morgan Stanley, right? And one of the key features is, of course, the research, as I mentioned earlier. Morgan Stanley is a multi-award winning research house on the institutional side. As you might know, more than 600 analysts globally, equity analysts, economists, strategists, providing us with global insights. And in my team, which is comprised of 3 portfolio managers and 2 analysts here, we are lucky to be leveraging that great research, but it's not just, one source of input. It's a continuous feed of idea and continuous interaction with the team, right? And what's very important for our clients and anyone to know is that we do have formal committees with some of the most senior strategists among Morgan Stanley in the Australian and all of APAC region, right? Every month we have formal committee with them, exchanging ideas on the key views coming out of Morgan Stanley institutional research. Now, this is a fantastic source of insights for us, but it's very important to put that into context that all the views from an install point of view, they always stand on ideas, right? It's one idea on one view on US equities, one view on US macro, one view on US bonds. The other channel that we can leverage and that's been extremely useful to us is the wealth management research, because the wealth management research in the US is a very, very large entity, as you can see, with nearly, and actually more now than $5 trillion in client assets under management. They are supported by 150 analysts and strategists, and 8 leading thinkers our global investment committee. And why is that important to us and our clients? It's because this research is really framed around client portfolio management, right? And they have a team really working around best practices in terms of fund selection, portfolio construction, quantitative modeling, etc. So as well, here we have a very tight relationship with our peers in this team, and that's what helped us as well bring a lot of these very leading processes into our own investment process here in Australia that I'm going to now detail on the next slide. So here's our investment process, and as you can see, it's a 4-step investment process. Of course, before that, there's the discussion with the client in terms of investment goals. That is of course central to setting the right objective and the right profile for the client. But then the first pillar, and I should say first and foremost, is of course asset allocation. This pillar itself is split into 2 processes. There's the strategic asset allocation, which is going to constitute the benchmark or the reference point for each of the asset class for us in terms of long-term portfolio management. There's also the tactical asset allocation, of course, which is the way we respond to the changes in the macro and market environment, and also, of course, always trying to be ahead of the curve by anticipating, but also sometimes responding to unplanned changes. But going back to the strategic asset allocation, how do we set the strategic asset allocation? Where in our case, again, it comes from research. We first do the research in terms of capital market assumptions, right? We do come up with expectations for risk and returns, as well as correlations for the main asset class for the 7 years ahead. Again, a good example of the collaboration with the wealth management research in the US, we get the international forecast from the US team. We discuss those forecasts once a year when they are updated. And then here in Australia, we do our own set of forecasts for the Australian asset class, right? We're using very similar methodologies. Once we have that, we go into the portfolio construction phase, where we're going to optimize our various investment profile based on our risk and return constraint and objectives. Then we get, as I mentioned, to an optimal asset allocation, as well as ranges around that asset allocation. Those ranges will allow us to move the tactical asset allocation, to move the weights in a much more dynamic fashion to respond to the changes in the macro and market environment, as I mentioned earlier. So that's what the SAA is about, right? It's setting the neutral reference point, setting a risk and return objective for the portfolio, and setting bandwidth for the main asset class. Then we do TAA, and TAA, of course, itself is very much led by the research that we get in terms of investment views on the main asset class for the next 3 to 12 months. The next step, building on SAA and TAA, is active versus passive. And I'll let Wayne take over for the rest, given he's now heading all this process for us.
Sure. So I think probably one of the most interesting things that we do at Morgan Stanley, and definitely I think it plays into the licensee awards that winning, is this active passive model. So what exactly is it? So many years ago, our team in the US basically did some research on when is it a good time for active managers, when is it a good time for passive managers, and what are the sort of telltale signs in the market environment that can sort of give you a hint. So a lot of it is I can break the signals down into sort of three categories of what we look at. The first thing is dispersion within the market. So for example, if you're a value style manager, if the cheapest stocks are cheaper than normal and the most expensive stocks are more expensive than normal, then the gap is so wide that if you're a value manager that's particularly skillful, you're a leading value style manager, and you're able to pick those stocks that are going to re-rate, the amount of alpha you can add in that environment is much bigger than normal, just because the opportunity size, the gap is so wide. If you're a growth manager, we look at the dispersion in estimates for earnings. So if there's a very wide range of earnings estimates for companies, and we look at every single, for example, in Australia, every single company in the ASX 300, we'll look at the highest and lowest estimates for earnings. And if there's a lot of dispersion, then the good growth managers usually have a good track record of picking the companies that the market hasn't in consensus realized that they're going to be growing earnings ahead of consensus. And so it's how much breadth and how much room there is to move for those managers. If the dispersion between the most bullish and the most bearish estimates for stocks are quite small, then even the best growth manager can only add a little bit of alpha by picking the stocks that are going to grow a little bit more than the companies that earnings aren't growing as high. So that's the dispersion side of it. The second side of it is the macro environment. So obviously there's certain styles do better in certain environments. Obviously, like defensive style managers do well when there's a lot of fear. That's what we've seen in the last sort of the calendar year to date for most of it. Defensive strategies have outperformed some of the other styles of investing in equities. So that helps by having that big global team of economists and strategists to sort of help us through and give us the sort of a broad picture of what's going on in the world and how to position for that. And that obviously ties into looking at the different macro economic factors, to look at the data and see, okay, this is usually a type of environment. If we have the Fed and the RBA raising rates and the yield curve steepening, what does that mean? If the yield curve, if they're hiking a lot and the yield curve is starting to flatten and we've got some growth concerns, what does that mean for a value manager, a small cap manager, a growth manager, a quality style manager, for income style investments? And so across the board, that helps us to sort of navigate where we want active managers and passive managers. So using those legs, we actually have a model that uses a regression model. So this was patented by our team in the US almost a decade ago, and we've been using it in Australia for about 5 years now. And that helps us to set how much active allocations we want within our portfolios. The third and final leg that I should add to that is we also look at the way that the stocks are moving. So we look across the whole ASX 300, every single stock. Are they moving all in different directions, or are all the stocks moving up and down together? So the cross correlation of how markets are moving. So again, a lot of it is looking within the market, what's going on between different companies, different sectors, to try and work out if there's a lot of breadth of movements for active management. And that's been extremely important because it has added a lot of value to our portfolios, and it's something that we haven't, to our knowledge, we haven't seen other managers have actual models around that. So that's all very well and good, having good asset allocation practices and good active and passive models. But then obviously you've got to tie that in with manager selection, which is a third pillar. So as well as looking for managers that are consistent and having a whole bunch of quantitative tools, again, that have been developed both here in Australia and by our global teams as well, for assessing managers. We can also look at that against the other things. How do they work in different asset allocation environments, and how do they work? And when the active and passive model says, if it says it's a good time for a value manager and we find a value manager that we like, do they also outperform when our other models and our asset allocation models say that they should be outperforming? So each pillar builds on each other, and each pillar refers back to each other. And that goes through as well to the fourth pillar. When we look at portfolio construction and risk management, we use some of the typical things that you'd use, like a Bloomberg, some of our own proprietary things, but we also use some other third-party models, and they give us scenario analysis, they give us risk exposures. So we have a feel for our portfolios. the yield curve goes up by 10 basis points, what's that going to mean to our portfolio? If the RBA hikes rates or cut rates, what's that's going to mean to our portfolio? If the US dollar appreciates against the euro. So you look at all the different factors of risk and try and understand exactly where the risk is in your portfolio. And obviously, for all modern portfolio managers, that is extremely important to understand what your portfolio is sensitive to, where you're actually geared, and if there's no unintended sort of exposures that you don't really want, and all the risks that you're taking are the risks that you've researched and quantified, and you feel are adequate and appropriate given what you believe is the outlook for markets. So all of those four pillars build on each other, and they all support each other, and they all loop back and check on each other to get to the actual portfolio. And the key thing is, we run attribution analysis once a month, and we check all four pillars are actually adding value. So we make sure that we can see what's coming from asset allocation, what's coming from our active managers, within the active managers, how are they doing versus their benchmarks, and then again at the portfolio construction level, we do some back testing and seeing how has the portfolio performed in different environments as well. And that makes sure that we're on top of exactly all the levers that we can pull to make sure that they're all adding value to the client's goals, and they're all adding to this global multi-asset actively managed portfolio that the clients of Morgan Stanley and the licensees of our model portfolios are basically, that's the deal. That's what they want from us at Morgan Stanley, and that's what we're always aiming to provide. We can give you an example of this on the next slide. So, we obviously always hear that sometimes passive management is just easier, it's cheaper, it's very hard to beat, the S&P 500 or the ASX 300. It's very, like, most managers will underperform those benchmarks. And we don't disagree with that. Like, it is something like 40 to 50% of the managers manage to outperform. It's usually slightly less than half the managers will actually manage to outperform after fees. But what kind of gets lost is that within the asset allocation, that's not actually true, that there's a lot of room to be active within asset allocation, because a lot of asset allocation models are very static. So a lot of asset allocation models are sort of set and forget and rebalance quarterly or semi-annually. And we found that we can actually add a lot of value to clients' portfolios by being active. So an example is in 2020, if you look on that graph of the ASX 200, you can see when we came into the beginning of the year, when we were looking, all our strategists and economists around the world, particularly the ones in Asia, were looking at some of the data coming out of China. You could see that, even though we'd had this sort of COVID-19 Wuhan lockdown coming out in sort of November, December of 2019, coming into January and early February and post the Chinese New Year, you could see that coal consumption, traffic data, pollution, all the sort of high frequency data didn't pick up. So we knew that there was a problem. So we started cutting risk in our portfolio. Now, we didn't know that the whole world was going to be locked down sort of 6 weeks later. But just the fact that you can look at the data and you can see things starting to break down, and by being active in your tactical asset allocation, you can start trimming risk, means that we're already cutting risk long before the sort of the virus broke out all over the world, and we went into the sort of lockdowns in March. So you can see that we start cutting risk in the portfolio, and we keep cutting. And then when we get to around about the second sort of bubble that on the chart, you're now at the point where we're in lockdown. It's sort of mid-April, and we started, now all our strategists and all our economists around the world are asking the same question. How bad is this? Is this a Great Depression scenario? Are we going to be in a sort of 2 years of just lockdowns and just a lot of destruction of economic activity? And we did all the work, obviously having economists, for example, in the US and seeing what the Fed were doing, what the different central banks are doing, is that they assessed that the Great Depression scenario was unlikely. So you can imagine that we started cutting risk in February, and by April, we had sort of stopped cutting back and started looking to add risk back. And some of the calls going into by the third step there was when Morgan Stanley was in the V-shaped recovery, that the amount of stimulus was so supportive that we were going to have this huge rebound. So we started to add risk even more as the portfolios, and particularly we had called like a bottom for commodities, sort of in that between that sort of step 2 and step 3. So we had already started adding to commodities, really started a rotation from growth to value. and we started adding risk back to the portfolios. Okay, so that's all very good, but what does that actually mean for the client experience, for performance of the portfolio? So if you look in 2020 for the calendar year, our core growth model returned 5.8% versus the ASX 200, which returned 1.4%. And if we look at the Morningstar multi-sector peer groups for all the sort of what they call aggressive, these sort of high growth multi-asset models, they had added 1.8, they had returned 1.8%. So you can see that the gap from being tactical, being quick, using all of these tools can help you very quickly to move and to pivot as the data changes and as the whole world changes. So in an environment like that, where the whole world is thrown into chaos and we swing from a deep recession to enormous fiscal and policy response, you can see that having to cut risk and then add risk back is a huge difference for people that are doing that like ourselves, and the typical multi-asset model that's very static and doesn't do that. So if we turn on to the next slide, do you want me to talk to performance?
Yep.
So that's just one example of in 2020 how we did and thing. But if we look at the longer term, because obviously that's just 1 year, you could get lucky on 1 year with some calls. If we look at the longer term, which is the true testament, these portfolios, as Alex mentioned, have been running for over 10 years. And you can see that we compare ourselves not just to our internal asset allocation benchmarks to make sure that all those pillars are adding value. We also compare ourselves to the peer groups. And we also compare ourselves to a real return benchmark as well, so that not only do we have sort of real objectives are being met, but we're also trying to make sure that clients can compare us also to the competition out there. And as you can see, we're quite proud of the track record that coming to the sort of end of July, you can see that across all the risk profiles, conservative, balanced, and growth, we've managed to outperform peers, and we've managed also, that it's a bit hard to see on this graph, but that yellow faint line is a CPI plus objective as well. That's appropriate for conservative, balanced, and growth style investors. And you can see we've also managed to add value over that. So that's quite pleasing to see that the process works. And that all of those levers are actually adding value for clients and for licensees of the Morgan Stanley managed account system.
Maybe it's a good time here to just pause, and I'll just like to make a few points on the philosophy before we hand back to David, because it's a question as well that's often asked to us. In terms of philosophy, I say that the key thing here is we're trying to be flexible and not tied too much to a style of investing. As Wayne mentioned, we have no strong view on active versus passive. We like to be active when we think the time is right. We were happy to pay the fees, but we're trying to, have portfolios that are both, risk managed and fee conscious, right? So we try to pay the right amount of fee for performance at any time in the process. That's one of our key beliefs. And one other of our key beliefs is that we want to perform. We want to do better than competition. We want to help our client grow wealth well in excess of inflation. And in order to do that, we must take risk. We are risk takers by nature. But what's very important to us is that the risk that we are taking pays off, right? And one of the also quite an informal target that we have in mind is not only we want to return more than the peer group, but we also want to have a Sharpe ratio that's higher than the peer group, because that's the ultimate proof that the extra risk that we are taking when we are is really turning into added alpha. And these are really like the key things that we focus on when we are managing those multi-asset models. Now, I think we've been speaking for a while now, so I'm happy to return to you, David, and see if you have any questions.
Thank you, Alex and Wayne, for that very comprehensive run through. I guess maybe can we just start about talking about the portfolios you offer? I know in the final slide there you had the usual sort of conservative balanced growth. And you did touch earlier on about the different portfolios that Morgan Stanley offers to different kinds of clients. Can you just explain perhaps a little bit more that you had domestic, global, so what portfolios are available to advisors in Australia, and what other things does Morgan Stanley offer that maybe are not available on those platforms? Can you explain the differences?
Yeah, yes, thanks, David. So again, I think our what we wanted is have our core offering, available to most clients in Australia. What we call a core offering is multi-asset portfolios invested in cash, fixed income, and equities through ETF and managed funds domiciled in Australia. This is really the what we call the core offering, and we want that offering to be available to most people in Australia via the platform that I mentioned earlier, North, Net Wealth, and Premium. For our clients internally at Morgan Stanley, because we have this global platform that we can use and helps us invest into funds and ETF that are domiciled outside of Australia, and give us another layer of sophistication in terms of implementation, finding, very good managers. For instance, a great international equity manager based in London or in New York. This is what this platform is gonna make us able to do. That's one thing. And the second thing is also internally, we do manage a range of multi-asset models that would invest in alternative investments, right? We are quite big on alternative investments, and thanks to the Morgan Stanley platform as well, we are able to source a top-tier product that we can feed into our models.
Right. I mean, alternatives, I guess, is one thing that's getting a lot of publicity of late. An area people are looking more and more to for returns, given the poor performance we've seen, particularly in the short term, maybe from equities and bonds. So is that a more difficult asset class to offer through the platforms, the hedge funds, the real assets and so on?
Yeah, absolutely. So there's probably two aspects in the question. I'll answer to one and I'll let Wayne address the other. The first thing is from a pure asset allocation standpoint, which is my background. What we found is last year when we did our refresh of the capital market assumptions, we found that usually alternatives offer a higher Sharpe ratio, risk-adjusted return, than long on the asset class, but the absolute return expectations wouldn't necessarily be above the long on the asset class. And this time, when we ran those assumptions, most alternatives asset classes were offering superior return in absolute terms versus long on the asset class. So the case for having more alternatives in the portfolio was extremely compelling, and we pushed a lot more into our default weight, i.e. the SAA. But what's very interesting is that this was 1 year ago, and we were expecting that view to unravel over a couple of years. But 1 year down the track, on top of being positive from an SAA standpoint, we've been extremely positive on a TAA standpoint, and we've run another weight on top of the SAA weight. So it's been a double increase, and that's paid off extremely well, given our models with alternatives have performed a lot better. So that's for my end of the question. Wayne?
Sure, and I guess, David, you touched on it, and I think that's the same problem for all of us that are building portfolios for clients, is finding the right alternative asset managers. The products are more complicated. There's a lot more going on. You can't just go out and say, for example, I want a market neutral hedge fund, and I'm just going to try and find one, and just, you have to do a lot of due diligence. A lot of the processes are very different. You have to meet every single manager. You have to go through all the portfolios. You have to look at them in all sorts of different environments. And you have to understand what they're doing with derivatives, with leverage. It is a lot more complicated. And then when you start getting into the private markets, there's a huge number of issues with liquidity, and that's also hard for various platforms. If you have a platform, in the case of our models, that rebalance something like 10 to 12 times a year, potentially, you can imagine if you have something that's quarterly liquid, how do you sell it and then fund what you want to buy if you're not going to get the money for another 3 months? It breaks the whole system down. So we've had to deal with that internally and find different solutions. But I think for most platforms, we're still not yet there of managing that liquidity, where you have something that's daily liquid that you want to buy and something that's quarterly liquid that you want to sell, for example. How do you match those? And you have these liquidity mismatches that makes it very difficult for managed accounts. So obviously, you know, the technology moves every year. And if it gets to the point where we find some ways of managing that a bit better, I think that's something that we could look at in the future. It's really about the technology catching up to and also the product providers. We've seen a lot of these managers come through and make sort of private equity funds and private infrastructure funds and try and make them quarterly liquid was the first step, and then make them monthly liquid. But you still got to manage that, because even if they have some limited liquidity, they could still, in a crisis situation, still lock the portfolio up and say, no redemptions. So it is an issue that everyone that's trying to offer these alternative products is trying to manage the sophistication of the hedge funds versus, you know, what the client is willing to accept, and also the liquidity of some of these private market funds as well. So it is a lot more difficult to get those into clients, as I'm sure all of us trying to sell alternatives would be aware of.
And a question that I've got, which sort of grows out of that then, is, I mean, Morgan Stanley has a far higher than average net worth client base. So has your own internal client base sort of changed the types of investments that you contemplate for portfolios, lead you to run sort of a retail and wholesale version of portfolios?
Yes, absolutely. I think as we mentioned earlier, like we wanna have a specific range of models that is very sophisticated and by nature and tailored to our client base. That's very important to us. So we have those sort of offering, highly sophisticated, where the client could be investing in the multi-asset portfolio, and that would be all of their investments with us. But we also have a very sophisticated clients that also want to be involved, and for whom this solution is going to be the core of their investments, but they also want a satellite part where they're more involved, either in stocks, domestic, international alternatives, with a lockup periods, for example, or any other of more opportunistic type of investments. And in this case, we're very happy to sit down with the clients and the product team of Morgan Stanley and structure something with this sort of core satellite approach that would fit the client's particular need, right? So this like two sort of offering that are very different, but that we want to have our clients enjoy also at Morgan Stanley.
Okay. Now, of course, just a reminder that questions, if there are anybody in the audience who has a question, we welcome those. David.
Yeah, sorry, maybe one more thing from me, and perhaps I think we do have a few questions here we can move on to. I was just going to touch on communication, guys. I know, as I mentioned, that was one important part of the awards judging. You touched on it very briefly in your presentation. Can you just give us a bit more information about the sort of communications you do with advisors, particularly maybe, and the frequency, whether it's written, do you do in-person presentations? How do you do that?
Yeah, thanks, David. So we actually do a lot. Again, because these words mean something to us. Like everything starts with research, right? So for us to make a change in our models, we first must publish a change in views. So very often the publication flow is such as we put out a paper that, of course, our client would receive, talking about the changes in view. We publish, at least every month, something in terms of asset allocation, a full review of asset allocation and macro views. And if that leads to a change in view, then this will be followed by an implementation report when we talk to the trade that these changes in asset allocation mean for our multi-asset models, right? And of course, our client would receive update on that. And then every month we publish our performance report with commentaries attached to it. And at the end of the quarter as well, Wayne writes a very, very interesting piece on, quarterly multi-asset report that talks to the main changes in the macro and market landscape, as well as how that fed into our model portfolio positioning. So that's for the written communication side of things. So that's already quite extensive. But we're also doing roadshows where we go across the country, visit clients in each location and talking to our key views and positioning, webcasts for internal clients as well as external clients on a quarterly basis. So that's plenty to choose from. And if I may say, very often client has to be quite selective in terms of how much they receive, because it's quite easy to get overwhelmed at Morgan Stanley with the amount of research that you get, knowing that they're also getting all the institutional research as well.
Yeah, the one thing I'd add to that is, like the platforms, whether it's, for example, AMP, NetWealth, Premium, that we use for external clients, they all have their own due diligence teams, as they should, right? And whenever we add a fund, and we've done all this quantitative work, and we've done all these tools, and we've met the managers, and we've written up this long report of why we like the manager, we have all the data, all the output from those tools, all the questions we've asked the manager. We've written up that whole report of how the fund behaves. We provide that to the platforms, to NetWealth and to Premium. And we say, look, we've added this fund. Can you turn it on your system, or check that you can turn it on the system if it's not available? And we've done the due diligence. And if you need any further information or things, so it helps them, obviously, if they've got our extensive due diligence note of all the things we found in that particular fund or ETF, of why we've actually selected it. So for them, it's also helpful because we're sharing the research and the rationale of why we're adding these instruments as well. So for their own due diligence, they can go and check what we've written as well. So it's just another source of information for them when they're doing their due diligence. So our clients also get the benefit of that as well. It's all published research. So coming from a research background means that every single decision we make has a piece of research attached to it of why you've positioned that way, of why you selected that fund, or how you manage the portfolios. Everything from our strategic asset allocation process, and that it's all documented through research notes that are published to clients.
Excellent. Toby, I might hand over to you to see if there are any questions from our webinar participants.
Yeah, I guess there's a question here about the use of internal product and whether Morgan Stanley, itself offers funds or ETFs or foreign-based product for inclusion in these portfolios.
Yeah, well, very easy. None. Zero Morgan Stanley product in the Morgan Stanley multi-asset portfolios.
Okay. And I guess the other question which has come up is the relative, the sort of typical exposure as between active and passive. So you have a process for determining whether active or passive in any particular asset class is likely to be more attractive, whether passive or active is likely to be more attractive. But the question is, okay, so where does that leave you, typically? Favoring active, favoring passive?
At the current moment, which might be surprising because the dispersions are quite high, we actually only have 30%, just slightly above 30% in active managers and about 70% in passive. And you'd say, well, the dispersions are so high, why is that the case? And it's so volatile. Well, what's actually happened is if you actually look at the cross correlations between stocks, it's the whole stock market is generally coming down and coming up, with the exception of maybe things like resources and energy over the last sort of year. It's been actually moving together a lot, and active managers have actually been struggling through this process. A lot of them have been underperforming. So it's actually a period where, even though the dispersions are high, the other factors aren't boding very well for active management. But that's as low as it's been in the almost 7 years I've been here. We've never been that low in active managers. So I don't think that's not normal, and I don't think you'll see that for very, very much longer. Probably it's healthier to be 50, and sometimes it could, the pendulum would swing all the other way to about 60%, 70% active. Is probably the highest as well.
And if I could add something as well, is some of that is also asset allocation related, right? Right now we have no exposure to both Australian and international small caps, which tend to be buckets of the portfolio where we will go active, because on average, active management tend to do a lot better in those fields. So there's also a bit of asset allocation impact here.
Can I ask just maybe one more question, if I may? And that's, I was intrigued about the research you have access to, guys. And, you outlined the huge teams globally, both on the institutional and the wealth management side. I just wondered how you combine those. I mean, presumably there are times where perhaps they don't agree. So if you're a lot of economists has a view on inflation and the other side's maybe got a different view. How do you work that out?
Well, I think we have to be humble. Like our main skills are around portfolio management and portfolio construction. Of course, we have steady background in asset allocation, but it would be, in my opinion, a bit how would I say, we'd get ahead of ourselves, starting to second guess our US economists on the trajectory for US GDP, right? We are not US economists. We are a multi-asset strategist and multi-asset portfolio managers. So we think we are pretty good at taking those research views, putting them together, selecting which ones fit best in one portfolio context for the Australian, for an Australian investor. But it's very important to respect the firm's overall direction in terms of macro and markets. We again have the phenomenal advantage of being supported by the leading research team in the world, or one of the leading research teams. We have a phenomenal, market views and macro views, and we must use them to the max.
The other thing I'd add to that is that, the institutional research tends to be sort of 1 to 2 years out. So obviously, for example, equity analysts on the institutional research side are very concerned with getting the earnings forecasts right for the next year to two. The wealth research, looking at client portfolios, is usually on a longer time horizon. So they do a lot of work on portfolio construction for a cycle for long-term investment goals. So we also have to understand that the different research is aimed at different audiences, and how does that actually fit in? So you tend to find the institutional research is very helpful for tactical timing and short-term calls, and the wealth management research is very good for portfolio construction, 7-year and 20-year forecasts in terms of building the strategic long-term asset allocation guidelines and boundaries. So even though they may have, sometimes it seems as if they're saying different things, when you actually look at the time horizon, it makes a lot of sense.
Thank you.
Great. Well, thank you very much. I mean, that's an excellent point to finish up on. So, Alex and Wayne, congratulations on winning this award. It's, to my mind, it's one of the most important ones, and what you've demonstrated today is that is both the depth of resource and the depth of thinking that's needed to deliver a reliable and predictable outcome for retail investors. So thanks very much for your time today. Let me just wrap up then by just reminding you of the upcoming events for us. So in a week's time, we'll be looking at the ESG portfolios, and then in October, in about a month, we'll be looking at portfolio management thinking in independent thought. So I hope you can join us then. Thanks very much to David, to Alex, and Ron from Morgan Stanley, and we'll look forward to talking with you next week. Thanks very much.